Hey guys, hope you and the families are doing well. We know that recently the US markets have undergone a significant correction. However, I was able to use that to my advantage and enter within 1%, that's 1% of the market bottom in various longer term accounts. So what I'm going to teach you in this video is how did I do that? What was I looking at to indicate that this could be a reliable longer term market bottom that has formed? So I think you're going to find this video enlightening. I don't think you're going to find this kind of stuff anywhere else on YouTube. Market Surge are today's video sponsor. They're my go-to resource for analyzing company fundamentals. If you're interested in a discounted trial, you'll find a link to that in the comment section and the description below. Okay, let's get into the video. So there's going to be three main parts. Part number one is going to be focused on breadth. Part number two is going to be focused on understanding the character of the market. And we've seen many gap down reversal bars on a Monday. That was pretty key. We're going to look at a chart of the NASDAQ 100 when we do that. And part number three is going to be understanding volatility from a historical perspective and what tends to happen when you get big spikes in the VIX above 50. So let's start off with part number one, which is breadth. So we've got three charts here. We've got the S&P 500 on the weekly time frame, and then also on the weekly time frame we've got the S&P 500 percentage of stocks above their 50-day moving average and the S&P 500 percentage of stocks above their 200-day moving average. So weekly time frames all lined up here. Now important to note for S5FI, which is the S&P 500 percentage of stocks above their 50-day, and S5TH, which is the percentage of stocks above their 200-day moving average, the scaling here is in percentages. Okay, so this red 75 is 75% of stocks in the S&P 500 are above their 50-day moving average. That would indicate that the market is overbought. 25 is 25%, indicating that less than 25% of stocks in the S&P 500 are above their 50-day moving average. That would be oversold. So I have shaded these areas. So greater than 75% is overbought, less than 25% is oversold, and that is applicable as well for the 200-day readings and also for the 20-day readings. But we're going to stay here more big picture, focus on the 50-day and the 200-day, looking at the S&P 500 and bringing in a little bit of structural analysis as well. So our focus is really going to be on the 200-day and the S&P 500 here on the weekly chart, because what you can see is when the 200-day moving average breadth reading goes into oversold. So what does that mean? That means less than 25% of stocks in the S&P 500 are above their 200-day simple period moving average. Now the 200-day is effectively this red line that you see here on the weekly chart, which is the 40-week simple period moving average. But if you just take a look here at the correlation, okay, so we have a reading in here in late 2018 into 2019. You have it at the COVID lows down here, the COVID crash. You have a bit of a double dip reading. Okay, down here you have a quick one and done, dips its toe into oversold there and here. So if you were just looking at the 200-day moving average breadth reading and then you correlate that with, well, where is that reading coming through? It's not bad right here. Okay, kind of more of a longer term recession, you get a bit of a double dip in there, but then you look at here as well, and then obviously most recently here too. That's not bad. If you're looking at a market indicator to think when is there potentially a big move out of the tide. So I think about these moving average breadth readings as tides. Okay, when they're in overbought, the tide is in. Now when the tide is in, where is the tide going to go? The tide is going to go out. And when the tide is out, where is the tide going to go? The tide is going to go back in. So it's cyclical in nature. It's tidal in nature. It moves in, it moves out. It moves in, it moves out. Now, if you're looking at the 50-day, the 50-day moving average is going to be closer to the price action in the vast majority of cases. So you get more readings. Do you see here with the 50-day? Okay, you're oversold. So the tide is out and then it goes to overbought, the tide is in, and you can see these quicker oscillations between that tidal nature. Tide goes in, tide goes out, tide goes in, tide goes out. So the 50-day and the 20-day, which will be S5TW, is going to be closer to the price action. So you get more readings. But what I'm doing here is going more big picture. So when you see this happen in the future, and again, it doesn't happen very often, maybe once a year or so on average, okay, you've got to then be aware about this, because when you're at these extremes, okay, when the 200-day moving average breadth reading is in oversold territory, things don't look good. Okay, the news is bad, this is happening, that's bad, that's bad, that's bad, this is bad, this is bad. Understand your emotions at that point, and the news flow at that point is going to not be good. This is key, okay? The news flow, when you think about this, okay? This is probably the one which strikes the chord the most, right? The lows down here in March of 2020, okay, COVID times. Look at the breadth reading. What was your feeling? What was the emotional state? Where was the world then? And then where'd you get the oversold reading? So it's when you're at the extremes of sentiment, which can then be everything here, oh, super duper bullish, like let's say up here, super duper bullish, everything's looking really good, this is going to happen, the economy is doing this, it's all wonderful. That's usually when you're getting these moving average breadth readings in overbought territory. 20-day overbought, 50-day overbought, 200-day overbought. Everyone is happy, everything is rosy, the news flow is good, things are great, things are just going to stay great. But if you're thinking longer term and you're thinking more contrarian in nature, Warren Buffett's quote sums this up perfectly. Be fearful when others are greedy, and greedy when others are fearful. When 200-day moving average breadth readings are down here in oversold territory, so less than 25% for the S&P 500, could be the NASDAQ 100 if you're looking at that, could be the NASDAQ comp. When they are less than 25%, okay, that is when there is a lot of fear. And we're going to bring the VIX into this as well, because it's not just one thing, it's a combination of things. Now, from a structural perspective as well, as if you look at the lows in 2020, do you see how it bounces off the low or undercuts and reclaims here? Little kind of Wyckoff spring type action in there for you. Okay, do you see how it trades down to this blue zone, which I've just shown as potential support, and it's then a confluence of going into oversold territory. And the prior low marked by oversold territory. Interesting, right? So if we take a look here, we've got a major low. Here, very similar kind of setup here. What do you see? Trades down to a major low, moving average breadth readings on a 50-day, 200-day moving average basis, going to oversold territory, big gap down reverse bars as you can see, and a nice reversal. So this here, if you're thinking about kind of longer term accounts, so I think about shorter term active accounts, medium accounts, longer term accounts, this is some key stuff that I pay attention to in longer term accounts. Okay, and understanding that my emotions at these extremes down here, okay, down here recently, and think about your emotions as well. Okay, around the lows of the 2022 bear market as well. What were your emotions like? But when's the best time to be buying in terms of longer term accounts? This is really, really helpful. Like really helpful. This is not an indicator as well. You'll have to set it up as well yourself in terms of the shading and the level there. Pretty easy. Just use the rectangle tool and a horizontal rate for the level. Let's now go across, okay, to this, because this was fairly key. Okay, this may be a little bit of a nuance, but you've got to understand the market's behavior. What we had seen leading into this, okay, so it's Monday the 7th of April where you get the capitulation low, and we're going to go take a look at the VIX on the next slide, on the next chart. Okay, what we were seeing on a Monday frequently over many months was gap down reversal bars on the Monday. Okay, quite commonly we'd see a weak Friday close into the weekend, and then we would see a gap down reversal bar on the Monday. So the prior capitulation flush was actually on the 5th of August. Okay, as the triple Qs did a gap down reversal bar off their 200-day simple period moving average, which is the red line now on my chart. Okay, so what happened is the prior close is up here. Now, why I call it a gap down reversal bar is price gaps down and then reverses. Makes sense, right? Pretty straightforward stuff. So what we see here is the prior close is up here on the Friday, gap down below the 200-day, okay, and then it turns around, really strong action. Look at the pop in volume, nearly really nice rally. There were some really good trading opportunities in terms of 5-minute opening range breakouts, what I call Morello's intraday mean reversion longs on this day as well. Like some really, really good opportunities. And there's been just a proliferation of great opportunities recently as well. So that's a gap down reversal bar. But that's just not a one-time thing there. If you go and look, I've just marked some up, okay? Gap down reversal bar, Monday the 13th of Jan. Gap down reversal bar, 3rd of February. Gap down reversal bar, 31st of March. Gap down reversal bar, the biggie, on 7th of April. And look at the pop in the volume, look at the huge relative volume. So heading into the 7th of April, I was very aware and attuned to, okay, we're trading down to this prior low here, which was the prior low here that you see, okay, of the prior capitulation flush. And it's very common that there have been gap down reversal bars on a Monday with spikes in volatility. So this is the market's behavior. This is what the market had been doing many, many times. Now, did I know that it was going to turn around and go to this big capitulation flush? I kind of thought it would do, because like the market was setting up for this. Okay, the market will either, during corrections, will either scare you out or wear you out. Up until the 7th of April, it had been kind of wear you out, hadn't it? Okay, if you were just trading on the long side, because you only traded on the long side for some reason, if you only traded on the long side, it'd been wearing you out, wear you out, wear you out, wear you out, give you a little bit of hope, wear you out, 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 and then boom, scare you out on the Monday. Big gap down. Really weak Friday close, big gap down like this. Had we seen something similar here? Okay, wear you out, wear you out, wear you out, scare you out. With the sound effects onto the Monday. See that? This is what the market does. Think about Black Monday back in 1987. Okay, weak Friday close, boom, big gap down on the Monday. It's not uncommon, and it's actually quite common that market capitulations happen on a Monday over the weekend. Okay, They get driven lower, driven lower, driven lower. People panic out, puke on the Monday, and then the reversal comes in. This is what the market does. You've got to realize the reality of the situation and realize the characteristics of the market. Okay? And then what we have here, then on the 9th of April, is where Trump then did the 90-day tariff pause, and then it was boom, up, up and away post that. So let's now bring in volatility as well, because again, it's never just one thing. So what we've got here is we've got three charts. We've got the S&P 500 on the weekly chart going back to 2008. We've got the VIX on the weekly chart, which is the volatility of the S&P 500. So the volatility S&P 500 index being the VIX, the VIX, going back to 2008. And then as well, like we were looking at with the first couple of charts, the S5TH, that is the S&P 500 percentage stocks above their 200-day. Remember, that's going to be in percentages, 25%, 75%. But with the VIX, okay, there's three volatility regimes with the VIX. There is the money bucket volatility regime, there is the whipsaw volatility regime, and there is the danger bucket volatility regime. So what the market absolutely loves, I'm going to give you a little lesson here on volatility before I get to the point about the big spike in the VIX. What the market absolutely loves, okay, or what kind of money loves in general, is money flees assets with rising and high volatility. Okay, money flees assets with a rising and high volatility. However, it seeks assets with falling and prolonged low volatility. So if you were to go and take a look, I appreciate this chart here because of the kind of scaling effect here. If you go and take a look at 2017, okay, the indexes for that year, I think the NASDAQ 100 was up around 30% for the year. If you take a look at volatility for the year, this is just as textbook kind of trend could be. And it happened in 2013 as well. Okay, you see this? Look at this in 2013. What do you notice about the VIX during the entirety of 2017? So it's basically this period in here. The VIX is sub 19 for the entire year. 2013, effectively, other than a couple of little pops up there to around 20 or so, but it stays low 20s tops. Do you see this? Take a look at that. Look how low the volatility is, and then look at the trend in the market. Money seeks assets with falling and prolonged low volatility. This down here is falling and prolonged low volatility. Take a look at this really steady rally as well. Okay, in here, look at the volatility. This was then pre-COVID. You see? As soon as volatility starts to spike, money doesn't like that. It's why a bank will give you a mortgage on a house, but you can't go and mortgage your S&P 500 ETF. Too much volatility. Okay, money likes assets with low volatility. So realize when the VIX goes through a prolonged period of low volatility and or trends down from a very high historical spike, money goes there. Money likes it. Okay, so if we now look at the VIX spiking above 50, which is what we had, okay, this is a weekly chart. Look at that recent spike in the VIX above 50. If you look back over the last, what's that, 17 years or so, how many VIX spikes above 50 do you see? There's one here. Okay, COVID in here, kind of a little spike in there, just about to 50, just about to 50. Here you get a couple of spikes, but not really to 50, just underneath 50, like high 40s, and then 2008, 2009. It doesn't happen very often is the point. And take a look here at the S&P 500 percentage of stocks above their 200-day. Note the readings down here. Note the reading in here. In here, okay, this is what we looked at earlier, but now we're just going back a little bit further. It doesn't happen very often, guys. It really doesn't happen very often. And again, think about the prevailing emotions, what's going on mainstream media, what you're seeing, your family's seeing, your friends are saying this, that, oh, it's terrible, this, oh, no, bad. Really good from a long-term perspective. So this is how you then train your emotions. You train your psychology to do the opposite of what you want to do. Okay, you realize this. You realize how the game is played. Realize that when you get VIX spiking above 50 and 200-day moving average breadth readings into oversold territory, and that the market is capitulating and correcting because of uncertainty, self-inflicted uncertainty, by the way, because of the tariffs, and that Trump eventually was going to cave into the pressure, like because it was so self-inflicted, it's not a run-of-the-mill kind of bear market, it's self-inflicted, it's the uncertainty of it. As soon as Trump U-turns, or the Fed says, right, we have got the markets back. As soon as that put came in, okay, by the Fed, by Trump, the market was just going to turn around and rally. Plus, you got the VIX spiking above 50. Plus, you got 200-day moving average breadth readings into oversold territory. So what I hope this video does is next time around, maybe that's 6 months from now, maybe that's a year from now, who knows? Maybe it's 2 years from now, I have no idea. Next time you see that 200-day moving average breadth readings have gone into overbought territory and then trend back down, okay, into oversold territory, hopefully you'll be more aware of this. And you'll start using moving average breadth readings in your day-to-day, week-to-week analysis of the US major indexes and being aware of volatility spikes as well. And that the VIX spiking above 50 does not happen very often. Does not happen very often. Then you train yourself to do what you need to do at certain points. Remember that Warren Buffett quote: be greedy when others are fearful and be fearful when others are greedy. So I'll wrap it up there. Thank you very much for watching. Hopefully that was useful. Thank you for supporting the YouTube channel. As always, I look forward to seeing you in a future video.